Now, forget predictions. These 10 lessons are the difference between winning and losing. Most people invest blindly, then wonder why they are stuck. Now, in this video, I'll be taking you through a step-by-step process of the lessons that could completely change your financial future this year. Are you ready for it? Now, but before I start, I'm Trader Cassie. I'm an educator and investor. I help beginner traders and investors cut through the noise, trade with clarity, and understand that truth actually grow wealth in the financial market. Now, this is someone who has been in the game for over 10 years, survived brutal market cycles, emotional roller coasters, and I'm here so you do not have to learn the hard way. Now, so let's dive into the lessons and talk about the 10 investing lessons that could transform your future in 2025 and beyond. Number one, only invest in what you understand. Peter Lynch said, know what you own and know why you own them. Now, if you do not get it, don't put your money inside. If you do not understand the business model to it, of any asset class you want to enter, of any asset class you're interested in, don't put your money there. Now, here's an homework, a very quick one that you can engage in if you're planning to make a decision. Find out how the company is making money. If you want to buy a particular stock, go and find out their business model. How are they making money? How are they generating cash flow? So you do not need high-sounding language. You do not need a PhD to understand what the company does. If you look at a company, you look at an asset and you cannot tell in simple terms what it represents, how it generates profit, carry your bag and leave particular assets because you cannot manage what you do not understand. You know, in 2021, during the hype, many people bought NFT, crypto, and all of this AI stock with zero research. Now, some of them pumped, some of them crashed. In fact, a lot of them crashed. Now, most buyers could not even explain how the business make money. They jumped into this asset because of FOMO. And here's a lesson for you. Do not invest in hypes. Whether it is Tesla, NVIDIA. I have a video on NVIDIA that broke down several reasons why you should pay attention to that. But that is me explaining it in a way so you can understand before you invest in it. So do not just invest in hype because someone told you. You only do that unless you truly understand the business model and how it generates profit. Now, for example, if you understand how Coca-Cola makes their money from beverages, you can as well start from there. You build out your competence as you grow. So only invest in what you understand. Number two, only invest what you can afford to lose. If you are in the financial market, this will be a popular mantra for you. Now, if you are investing your emergency fund, if you are investing your savings, if you are investing the money you plan to do wedding, you are already playing backward. I remember 2016, a number of people invested in Ponzi, and if you hear all of the testimonies, all of the agony, it revolves around using their savings, using the money they've allocated for wedding, using the money that was designed for rent to play kalu. And that is an invested mistake I do not want you to engage in. Only invest what you can afford to lose. Now, we are even talking about genuine investment and genuine investment opportunities, but this principle remains the same. Now, if your car breaks down, for instance, and you have to sell your stock, you have to go to your money mutual fund to retrieve your particular savings, to retrieve your particular investment, so you can attend to your car that was broken. You have lost it twice. It means that you do not have an emergency fund laid down, and hence you are tampering with your investment. So what do? You build your 3 to 6 month savings. So your savings should cater for emergencies. Your savings should cater for other aspects of your lives, while your investment remains the same. Now, if you put your rent money in meme coin, meme stock, penny stock, because you're open for a quick fix or a quick flick, maybe 0 to 100, 10 to 1,000, 1,000 to 10 million. That's not just investing, that's pure gambling. As a matter of fact, gambling when we are suit. So don't just invest your money because you need it soon. You have to build a strong financial foundation first. So there's something they call liquidity risks. The money you're putting into your investment portfolios should be money you do not even need for the next 1 to 2 years. So you can allow money work passionately for you. Not be money when you don't go save, rush, don't the rush, you won't go carry and come out. Do you understand? So only invest what you can afford to lose. Number 3, be a long-term investor, not a day trader. Warren Buffett said, if you are not willing to own a stock for 10 years, remove your hand. Don't bother thinking about owning it for 10 minutes. Now, this principle is a principle that has helped a lot of investors navigate their paths to profitability. Because you see, day trading can make you feel smart, especially when it comes to the stock market. But guess what? It sometimes empties your account. Because real wealth is built with patience. Long-term investing gives you compound interest. It allows your money work passionately for you. That's compound interest. For me, compound interest is simply allowing your money passionately for you with time. So you allow your money work passionately for you with time. So compounding growth works like magic. But it is only for those who give it time. I'm going to take another lesson where I will talk about how to beat inflation. You know, a number of people will say, I invest Naira in so asset, I invest this in so asset, and this is the return on investment. And they are doing a comparative analysis with USD. You are not in that country. Now, I'm going to do a video how you can use an approach, a systematic approach, to overcome and beat inflation using these asset classes. That will be another video for another time. So long-term investing is like planting a tree. So it should be more or less like you're watching a paint dry. You know when you paint your house, you get where you just they wait, make it dry. Or you know when you plant a fruit and all of that. You tend to it, you water it, then you watch it grow. That's how investing is. So if you want all of those emotional roller coaster, all of those excitement, and to go Naira bet place pool. So your greatest edge as an investor is your long-term orientation. Not you buy a stock and no, you want to cash out. No, that's a wrong approach. Warren Buffett has made over 95% of his wealth after age 60. Now, do you know why? That's because he has a staying power in this particular game. He has reinvested his gain and did not even bother to chase any shiny object. So what you do when you invest in any asset class, especially when it comes to the financial market, is to think in terms of decades, 2 years, 3 years, 5 years, 10 years, and not just day. That's why some of us, when you buy Bitcoin, you're looking at it. Bitcoin never pump. Bitcoin, it they go down. No. It's a wrong approach. Whether stock, the crypto market, financial market, money market, capital market, what have you. So if your investment strategy cannot survive 3 years, it is not just investing. It's just gambling when they're packaged. Now, The fourth reason, don't time the market. This is another investing lesson I think you should hold dearly to. Don't time the market. It is not just about timing the market, but about time in the market. A number are so keen. You want to get a right entry, you want to enter at the right time. No, direction over entry. Direction over entry. Once you understand that this is going to boom, position yourself there. If price is going against you, apply dollar cost averaging. Add dollar cost average. So don't just time the market, because you miss out on the market best days. So when you have a conviction, follow through with your conviction. Because the market is not going to send you a calendar and say, hey, I'm going to explain on Thursday. I want pump today. We are come and buy. No. It just moves. And these explosive moves, they just come during chaos like war, election, recession, fear. Now, if you panic and pull out, you miss out on those great moves. You miss out on those great moves. Now, imagine you have invested over about 5 million in S&P 500 in 2023, or you bought Bitcoin in 2010. If you stay fully for 20 years, 10 years, 5 years, the money when it don't give you, to be massive. So what you do, just wait for a perfect time. There's no perfect time when it comes to the market. The best time is just consistency and conviction. You get? Now, number 5, always diversify and allocate intentionally. John Bogle said, don't look for the needle in the haystack, just buy it. And that's where the concept of ETF and index fund is very important, because instead of you buy several asset class, you're spreading your capital, spreading your money amongst several asset class, because you do not know which of them is going to boom. It looks like you're finding out to find the next Amazon, you're finding out to find the next Tesla or the next Nvidia. This is what John said. That's why John came up with this concept. He said, don't look for the needle. Just buy it. So this way, you will never miss out on the stock biggest move, the stock biggest winners. That's why you do ETF. That's why you do index fund. You diversify. Now, when we talk about diversification, it does not mean that you are owning over 100 stock or 100 assets in the same category or in the same industry or in the same sector. No, that's not diversification. What it means is you're spreading your capital amongst different industries and asset class. You have some in money market, you have some in crypto, you have some in forex, you have stock in stock, and so on and so forth. Even in stock, you have some in consumer sector, you have some in the agricultural sector, you have some in the banking sector, you have some in the technology sector. That is spreading across several industries. It gives you protection. So if you have only airline stock as at 2020, and you know what happened in coronavirus, you will be greatly affected. Your portfolio will be greatly affected. So sometimes to diversify, you employ the strategy of ETF. You allocate across different sectors. You mix growth stock, you mix value stock, you mix crypto, you mix low rates, you mix high risk, you mix all of them together to give you a sound and robust portfolio. So do not diversify ignorantly. You diversify and allocate intentionally. Now, number 6 investing lesson to learn is don't be afraid to invest more. In this 2025, as of 3 years ago, I was telling a number of my subscribers, buy Wema Bank, and a number of people keyed into that. But guess what? They use small money buy them. So do not be afraid to invest more. When Wema Bank pumped from 4 naira to 13 naira, most of them were happy, but deep down, They knew that they would have made so much money if they had invested more. So Warren Buffett said, be fearful when others are greedy, and be greedy only when others are fearful. So do not be afraid to invest more. Returns matter a lot. It is just our capital. So fear will shrink your wealth potential. Do you get? So do not be afraid to invest more. Do not be afraid to invest more. Do not be afraid to invest more. Investing is like planting a seed. It will cost you more, but the fruit, you benefit from the fruit. So you invest early, you invest more. That way, you can amass that generational wealth you seek. Be fearful when others are greedy, and be greedy only when others are fearful. Now, number 7 on my list is use your life experience as an edge. Use your life experience as an edge. If you don't get it, don't put your money in it. Experience is a best teacher. Your advantage as an investor is your experience. You already know more than you think. If you've worked in logistics, if you worked in X sector, you worked in tech, that's your experience. That's your investor niche. That's your investor research. That's your investor edge. If you have passion for a particular sector, that is your unfair advantage. That is your edge. So you've seen product move from place to place, customer to customer. You've heard customer complain. You've seen how emerging technologies are popping up, and you are in those sectors. That's your edge. That's your edge. So you do not just need to be a tech person to be able to win in the market. You leverage your real world experience. There's a course or lesson I'll be doing in another video where I would explain a lazy man's guide to investing. And you'll be leveraging strongly on your experience. That's a video I will probably do sometime. But as an investor, you use your life experience as an edge. You use your life experience as an edge. Now, the 8th point is accept that losses happen. George Soros says, it is not whether you are right or wrong that is important, but how much money you make when you are right and how much you lose when you are wrong. Even the best investors lose money. You lose money sometimes, and that doesn't make you a bad investor. It makes you a professional investor, because every investor in this market will get burnt. The key is manage your losses so they do not destroy your portfolio entirely or destroy your confidence. In the early 20s, Y2K period, 2000, Amazon dropped about 90%. Bitcoin during coronavirus period dumped over 74%. Yet those who stayed calm during the Amazon and during the Bitcoin time, they regained their capital, regained profits on top as Jara, and they amassed so much wealth. So do not just panic when price drops. These losses are part of the school fees we pay to be in the school of wealth. These losses are part of the school fees we pay as we intend to use the financial market as a tool to generate wealth for us. So learn to accept that losses happen and move on. Number 9, don't romanticize your asset. You are an investor, not a fan. Don't romanticize your asset. You are an investor, not a fan. Let go when it's time. You know the way you hold on to a particular stock and say, my mentor gave me this stock, or this stock has given me so much money. I love this stock. A number of people are stuck in Solana because Solana gave them their big first breakthrough, and they are still stuck in Solana because they think that Solana is still going to pump. Will it pump? We never can tell. But now, they are no longer acting as an investor. Solana is a crypto coin. They are now romanticizing that particular asset. This is my asset. It gave me money. So what that does is they are emotionally attached to that investment. So whether it is stock, whether it is REITs, whether it is coin, any asset class, when you are emotionally attached to an investment, it will blur your judgment. It will blur your judgment. When you romanticize your asset, it will create a bias. And that bias will definitely affect your portfolio. So a wise investor knows when to exit, even if the stock was their darling or their favorite pick. There are several investments for stock, for instance. There are several picks I've made, done my due diligence, picked those assets, they've pumped, given me profit. And I left gently, I left quietly. No need to be a fan to the project. No need to be a fan to the token. No need to be a fan to the company. You are in this business to make money, not to be a fan. This is not football. You're not playing football. Now, even those people who are fans to those football guys, I honestly do not think they get paid, except they are gambling. So don't romanticize your assets. Don't. Please don't. It will create a bias. That bias will affect your judgment. Remember, in fact, put one hand in your chest and say, I am an investor. I am not a fan of any project, of any asset class. I am an investor, not a fan. I will let go when it is time. Now, the last one, which is very important, is coaching helps you see your blind spots. Benjamin Franklin says, an investment in knowledge pays the best. So sometimes you need another set of eyes to look critically at those your asset class, to show you how to pick this asset class, to show you how to see through undervalued stock, show you how to pick through low risk investment opportunities. Coaching helps you see your blind spots. You see, you don't know what you don't know. It's as simple as that. If you're not there, not there. And some mistakes are too expensive to learn the hard way. Trust me. Some mistakes are too expensive to learn the hard way. There was an investor I coached, I think, I can't remember the year, who had her money in about several stocks. And she was not diversifying properly. She was just investing in a particular sector. And when that stock dropped, majority of her funds, over about 80 something percent of our portfolio was tied to those asset class, and they were all in the same sector. When crashed or core, the market tanked badly and our portfolio went down. She was literally seeing our portfolio went down. She was seeing it going down. So every investor have coaches, mentor, and advisor. So coaching will help you see your blind spots. You cannot avoid risk. That's why you need a coach. Investment in knowledge pays the best interest. Investment in knowledge pays the best interest. Now, last and finally, having learned the 10 investing lessons that will change your financial fortune, here's a parting word from Warren Buffett. He says, the stock market is designed to transfer money from the active to the patient. I rephrase, not just the stock market, the financial market, because this channel is about the financial market. The financial market is designed to transfer money from the weak hands to the strong hands, from the active hands, emotional people, to the patient ones, to the irrational guys, to the logical people. So when next you are tempted to want to derail from your investing plan, Remember these wise words from Warren Buffett. The financial market is designed to transfer money from the weak hands to the strong hands. And this is very, very important. Now, thank you very much. If this video has helped you, if this video is valuable to you, please like, share, comment, subscribe, click on that bell icon. Now, I'm going to leave you with this question. Which of these lessons enter you? Which of these lessons hit you the most? Which of these lessons do you find yourself defaulting in? Which of them do you see yourself obeying? Which of them do you see yourself not following? And which of them would you pick up? Having listened to all of these investing lessons, you know you are doing some of them, you're not practicing all of them. Which of them do you intend to imbibe moving forward? Now, until we see again in subsequent videos, stay profitable.